Good afternoon, everybody. I'm Dan Hussey with Zaner Ag Hedge, bringing you our Strategy of the Week update here for March 17th. Happy St. Patrick's Day to everybody out there and those celebrating. Hopefully, you haven't gotten started just yet because we do have some things to talk about and some deep ideas about the option market to settle in. We're going to talk a little bit today about identifying ranges, how to trade ranges, or what are some of the option strategies that work best for range-bound markets. Not saying that I would necessarily put on a straddle or a strangle in the corner of the beans right now. I think we're getting a little late in the range, and maybe the the earlier there, the straddle might make more sense in this type of environment because you're looking for an explosive move outside of a range. That might be more useful in this exact environment. But if we had identified the range bound market that we are currently in the soybeans earlier, maybe even just 2, 3, 4 weeks ago, we could have done something like utilizing a strangle, selling the premium to sell and get short a call and a put to have made some money while that premium decays inside of this range. And we'll look at both how to technically utilize some price measurement tools and momentum indicators to look at how a range can be identified on a chart, and as well as some trading strategies to actually implement. Because range trading, other than trying to buy the low end and sell the high end with futures and playing ping pong with the market, there are option strategies designed to simply maximize on range bound and non-trending markets. So remember, trading futures involves risk and is not suitable for all investors, and everything I tell about here today is just my own opinion and not a direct trade recommendation. Let's get into and kind of begin with what is a straddle versus a strangle. They're two easily thrown around option strategy types. It is very simply put, two different types of building out a spread option or a spread chain that is pretty readily identifiable based off of what strikes you use and how far away those strikes are from each other. Straddle utilizes the typically at the money strikes to buy a put and a call. Betting on a non-directional trend is going to set in. In other words, I don't care if the market moves. I just want it to move a lot and as far away from this point in time and where we are in price right now before the expiration of those options. Of course, that gives you the ability to sit there and not fret over the market being bullish or bearish. That's a nice thing to not have an opinion on what direction the market goes, but it also comes at a premium. You pay the most amount. The at-the-money call and put are going to have a handsome amount of premium associated with them in both time value and being the at-the-money strike. You're not going to get them very cheaply. In any situation, bullish, bearish market doesn't matter. Your at-the-money put and call are mathematically going to be expensive relative to other options and that we might use from time to time. So the straddle, no direction. If we get an explosive move today, we can obviously see and the market moves a lot today. We could see some profitability on that type of trade, but we do have goalposts. In other words, how far away from the market we have to actually move is actually quite wide, right? Because not only do you have to move, just the cost of the put or the call away to recuperate. If you're just long a call, you need to get above not only the strike, but the strike plus cost to actually become profitable. Put the same way, you have to get below, plus or minus the cost in terms of price to actually become profitable there as well. Well, when you own both, you're paying premium for both sides. So now the entire sum of all the premium you paid plus the distance you've moved from the market, or minus the distance you moved away from the market, actually ends up being the sum of your profits or losses, because you have a very far way and actually range the market needs to move outside of in a straddle to become profitable. Now, very similarly, using a strangle is a way of maximizing, on a particular directional move or lack of direction in this case, without needing to be a bull or a bear. In this case, selling strangle, selling a put and a call outside of the money in hopes that the market stays between those two goalposts during the time and before expiration. That comes with some more risk, though, of betting on the market not moving and going very far, because if the market does move away and outside those goalposts, you now have unlimited risk. You could be put or call or assigned a put or a call, a short or long position from those options. based off of the expiration and even before so. And you might end up with unlimited theoretical losses because the market can move far away. Now, there's ways of limiting that, buying a put and a call above and below those strikes, making it what we refer to as an iron condor. But it's going to still be a expensive venture because now you're giving up some of the premium you brought in for now, getting that protection on. That doesn't mean there isn't a time and a place for any of these strategies because, hey, just trading futures has unlimited risk unless you put a stop in the marketplace and use orders to do so. And even then, the risk is not guaranteed. So the point is that understanding the risk before you employ any complex option strategy is absolutely imperative. Now, buying a straddle has limited risk. Long all that premium, that's all you can lose. If the market goes nowhere, you gave it all away. But that strangle, particularly selling a strangle, being short a call and a put, unlimited risk outside those goalposts. We'll look at what those look like here in the corn and soybean markets in just a minute. But I wanted to kind of first, we'll come back to those ideas. Let's give a quick market rundown here and talk about where the market's kind of been, gone, and where we might see it, follow through to. Before we get into our row crops, let's take a look at crude oil because it's been a very important, get rid of some of these charts, very important market to watch. We've had a 50% pullback now for the year 2020, basically lows of the year there that start around 62.50 all the way through the 130.50 highs. 50% pullback over the last week. That was right in the 96.50 area. Lows on this chart, 93.40 for the month. A very, very huge range for the month of March now. But having broken out of this $90 mark, now above 100 and having come back down and tested it as support, which, by the way, is also this trend line. We draw against the lows here. This trend line drawn, through last November, start of the year, and through some of those lows here in February, we've come down and held. The market is now bouncing a little bit. Here I say that we're $8 off the low, $10 off the low now for crude. 112.02. Just to sober us up for a moment, is the 50% retracement of this entire decline. It aligns here with this kind of confluence zone or this cluster of lows here back in early March that we held as support briefly on the first time down, but it was broken below. That might be broken support here now is resistance that we need to be aware of. See, here it's support, support, support. Even tested again as support here for a bit, but now we're below it. Well, we're coming up to test that as resistance, and we need to be aware that if the market were to turn over and go through lows, it does, to me, suggest that what we're looking at here in terms of retracement is probably not done. We need to take an even bigger step back on that daily chart. And realize that crude oil could have a major pullback all the way from 6 up to the highs. $68 is a 50% retracement. You can draw some other trend lines here from those March lows through the highs. That is going to continue to be supportive, but also could be levels that the market wants to come down and test as support, which means we could be in a bit of a bear trend for the time being. But nevertheless, 70 to 75 is a major area I'd be interested in if we got down there. But for right now, this $96 to $100 area is pretty clearly supportive for both psychological levels, reasons at the $100 mark, plus this cluster of old highs that we broke through, now testing the support. But to that point, we need to be aware of these this old support on that 4-hour chart I pointed out that broke here this last week and could be resistance on the way back up. And of course, the full 50% short off highs, 112 to 115 area. We get up there, we'll start talking about maybe the market going to new highs, but I think there's going to be more to read into in the rally off of this low than what is leading on. But recovery so far, the swings are very big. Support where it's holding in crude suggests that this market is trying to, put a base or create a base at a much higher threshold and maybe even has further up the summit to climb. So perfect, I think, jump into corn here because the corn chart arguably has some of those same longer dated trend lines that began the start of the year that are sloping up through the market that we could come down and test. The 17-13 area, equal legs down. If it were to trade down into that area, also would be a 50% retracement from the 655 lows through the 782 highs that we currently have in the market. That area would be supportive, in my opinion. That gap or that end of February there, limit up move we had that fell off of limit. That day, okay, the highs of that day or whatever are the resistance that we broke through, and we're kind of holding a support. I hate when limit moves and that line in the sand plays into a support or resistance line, because we don't really know how far the market could have priced that day. And if it was anything like wheat, it was $2 or $3 higher. It wasn't. I think it only priced as high as 730 that day, if my memory serves. But don't quote me on that. That's just doesn't really matter at this point. But it makes sense and kind of fits. If that high was up around 730, that's the resistance that we broke through on this chart that we've come back down and tested now time and time again for corn. So we're going to just say that because we see this ghostly figure on the chart, or the remnants of why so resistance could have been there because we're seeing support there. Sure. All right. So I don't love how this trend line against the highs has held today, but today was an inside price day until the the final hours of trade there, where we did push to a new high for the May beans. I believe, though, our December corn, I said beans, I meant corn. Yeah, December corn was still did not trade to a new high there, but also its charts a little different here. We've had a kind of a pennant, this multi-day correction here for May corn. That's been underway. Open gap down around 690. That's below lows of the month at this point. So effectively, so long as we stay above that level and that line in the sand, that is to me, a big indicator of where we could draw a line in the sand for this bull trend at this time. I'm a little, I would welcome a move down to 720. I would use this as a buying opportunity. I would be loading up on 760, 860 call spreads at that time. That would be a low-hanging gift kind of basket, if you will. Below $7, then I would reassess, maybe get out and wait for 660, 620, or even further down this rabbit hole if the market wanted to fall. But for the time being, I think we're trying to base and build support not only above $7, but right now above 730. And that's going to keep the pressure on the 750 to 780, and the thought in all of our bullish minds that we could achieve an $8 and beyond threshold for corn here. My only concern too, and I mentioned, I don't know if I mentioned it earlier in the video, but I wanted to take a look back here at what have we seen in years past, right? Let's look at May corn for last year for a brief moment and see where we were moving around on the chart. Is it doing the same thing we did that last year? That's beans. Let me get the corn. One moment. ZCK21. Perfect. May corn, yeah, a little dive here, but we still hit 775 there into its expiration. And keep in mind, look at how strong we were in the final days once we hit April 1st, right around the corner. Once we hit April 1st, and repeat that, we rallied an entire $2.10, actually more, $2.20 in May corn last year. And it was all after a very sideways consolidative like market. Look at that daily chart of May corn, May 21 corn. Okay, the last day on this chart right now should be today. Yep, the 17th. Okay, look at that little consolidation. I'll probably zoom in here so it doesn't show us the rest because we know where this market's going. But look at that daily chart. On the right side, I'm going to flip over to a daily chart of May corn this year. And boy, doesn't that look like the same kind of pennant structure we've held from February through March. We're in this doldrum period of the markets. Last year, we watched Chinese exports dry up come February. We've had exports for the last 3-4 weeks. In fact, Karen Braun from Reuters pointed out, and some colleagues of mine, Joe, and we're talking about how, whoa, look at that, export curve that China's done for this next market year. We've got sales on the books so ahead of the curve this year that China must be doing something. If they're eating hand to mouth, you still have to start to wonder how big is their belly. And I don't believe it's all hand to mouth this year. I think this is preparations on a larger scale for inflation, more global conflicts, pulling at the U.S., testing the United States fence, so to speak. But the moral of the technical story I wanted to pull apart on the chart here is that this consolidation we have during this period from February to March has maybe, hit its apex, or, we've hit a boiling point. And going into March 1st, or April 1st, excuse me, as you see, I stepped this chart to the side. We still have a little bit of up and down into the end of March, perhaps, right? We can still range trade for another couple days, 2 weeks. But once April 1st rolled around and we went into and got through our WASD and our quarterly grain stock and our planning prospects, we were basically off to the races for a $2, plus move there in corn, all the way through to contract highs. Where then after first notice, we had a little bit of pullback there, but it was a bullish trend and a $2 rally for May corn. That puts us at $10 corn. I'm not, I don't think that kind of observation or that type of call right now is crazy. If we repeat the same seasonal trend we did last year, there you go. I just walked us through how we get there. Now, I think we'll need to see a narrative develop. The acreage, for battle over corn is going to have to happen here. I think everybody who hasn't locked in, fertilizer costs at this point, or is worried about buying that hand to mouth come this spring, might, choose to do some beans. I hadn't heard as much bean on bean talk in my life as we did down at Commodity Classic. Now, I think there's only parts of the world we can get away with that, right, in the country. But it was an interesting discussion that people were having. Of course, it's discussion and talk's cheap, because when it comes down to putting into the ground the seed we want for the year, it's going to come down to dollars and cents. And for many of us, corn at the yields we're getting and the prices we're seeing is still an economical and viable option. But if soybeans take off here and we decide to buy acres in soybeans, corn's going to have to do the same. And if we have any kind of status quo to weather events, another thing we were talking about today was the first rain we've seen in months across the Midwest. If that doesn't continue, we have drought conditions already upon us. We're going into a year kind of dry, and if we don't pick up on that moisture into planting, we're talking about a poor production year for this year, on top of all of these other inflationary, strong demand, and generally speaking, bullish underpinning and economic indicators. So, and that's not even throwing into wrench the fact that I don't know how the Ukraine and Russia, we can sit here and honestly say that those acres are going to get done and done well this year. Getting them planted is one thing. Getting them off the field through the infrastructure and off to the global market is entirely another story. Aside from financial sanctions, I'm pretty sure we all just witnessed Russian tanks decimating Ukrainian infrastructure, roads and rail from across their entire western front, or eastern front. Depends, I guess, which side the coin you're looking at, right? But the moral of the story is a lot of those acres have farmland that doesn't have the infrastructure now to get the crop out if they wanted to. And that's assuming that there's going to be farmers and planters, tractors, combines, and everything else there to support the production. So, and again, all assuming that conflict comes to a resolution pretty much now, because planning is just days away. It's an interesting reason that I think maybe that's why we're seeing some of these markets uptick. Anyway, ran us through the charts here. A big reason why I think we could see us higher and see that breakout, which is why maybe doing something like a strangle, which we're about to talk about next, doesn't make much sense. But let's take a look at how that straddle in a corn market would play out over the next couple weeks. I guess before we run over there, let me at least give you the dailies here. That 18-day moving average for all these markets seems to be our reigning superior champion. We keep talking about this one and coming back to it as supportive here. Look at that, 7.27 and an eighth of a penny here today at today's settlement. That has we're right up to testing that with today's low effectively. So yet another test of the 18-day moving average for May corn. It's a hold. We rallied 30 cents off that level. And I would have loved to have seen us really break out and make higher highs in an outside day here, break through that trend line. But that's what tonight's for. If we gap up over that line, tonight could get interesting. But I wouldn't be shocked to see that one more pullback or some dirty dog price action, just like we saw when you look over this 2-week period. Looked like we were going to break out last year, but we pulled back, and it was like an April 1st kind of joke, and then we went higher. We'll see if that continues. 100-day moving average all the way down at 623, 50-day at 654, and down at 591 with that 200-day moving average. This market's not overbought on the daily time frame with that RSI. If anything, we triggered an oversold indicator there on the RSI, so plenty of room to the upside if it wants to break out, and we've got the technical reasons for it to do so. So even if we're not bullish here, and you just want to take a stab at the market moving from here, because I think we can all agree we're going to be above, we're going to be pretty far away from 750 either to the upside or downside here over the next 3-4 weeks. So there are options and there are tools we can utilize, and I gotta keep moving here. We're already 20 minutes in. There are option strategies and things we can put and utilize in this type of environment where we're getting ready for market to really break out and trigger one way or the other. I want to go to analyze. Got one built in here. We're going to flip. We'll come back to this. This is what a strangle looks like in the marketplace. I'll explain how the P&L curve works there in a minute. But let's hop over to corn because it had a straddle built in here. Perfect. Big old V. This, I was looking at two today, one in the May and one in the April. April only has 8 days left, so this is a very time-sensitive type of idea. Our April options, the 750 strike, because it's off the May contract here. So our 750 strikes are at the money strike. Here it is. So we're really concerned with, and we're going to go off of kind of this, more or less the last price for what they are. Those aren't the settlement prices. So I'll pull up my options over here to confirm them because I apologize. The settlements haven't come through here yet. We don't really need them, but because we can kind of guess enough. We know this is, I know this is going to cost us around 30 to 33 cents to buy for 8 days. That's a lot, right? A premium to put out of the money, in my opinion. Perfect. 750. April, 8 days. Okay, cool. Yep. Okay, 35 cents. We'll go with. That's fine. It's the point is the point will be made. Okay, so if we think we're going to be as far away from 750 as possible over the next 8 days, 8 days is not a great time frame. I prefer we had like 3 weeks on this, which is why maybe going out to the April will make more sense. But if we go out to the April, I'm sorry, the May, there's something else we'll consider with it, and I'll go over that in a second. But the April 750 call is going to cost you, it looks like around 20 cents. The 750 put here also going to cost you around 15 cents. So there's a 5 cent, wow, 5 cent skew there. That's a pretty wide skew to the call side. There's more, I mean, obviously in a big up day like this where you have 23 cents, that's what it represents. I would have expected maybe 2 cents, but nevertheless, the point here is that maybe the 755 calls more the at the money. The point is you're going to spend 32 to 35 cents here to buy a 755 Strangle or a 750 Strangle. We're just going to use the 750 because I had it. That's what I was ready for and was pricing out. And yeah, I had it at about a 36 cent cost anyway. Here I have it at a 34 cent cost. Perfect. So I put that strategy in here to show you owning a 750 April call and a 750 April put. Go over the risk profile here, and we can take a look at what the, how the P&L curve works a little bit. The purple line here is it in real time, so that's it priced off of where we, told the system we actually just bought and got into this option. So obviously, right now where we are, the market's made, at 750 where we are. This strategy hasn't made or lost any money. You can see the P&L there. As of 3/17/2022, that's what it would be if we got to that price, and of 3/26, which is the expiration in a week from now. And that expiration in a week from now is this green curve, a very important curve to pay attention to because that's the one that really matters a week from now if we hold this come hell or high water, how we could fare on the strategy. Now, if you notice, the whole point of this is that 32 cents that we just spent out of pocket, or 34, we're going to have to incorporate that. So if you notice, that green line doesn't cross over that zero threshold or get to being profitable again until we get above 784 or below 715. And then we start making money. In fact, you can make an infinite amount of money in either direction. It just matters how high corn goes in the next 8 days. You can make an infinite amount of money in either direction. But not until you overcome, right? Not until we get above that threshold here that overcome that cost of all that option premium we put in its way. So over 8 days, if we think we're going to get above 785 or below 715, spending 34 cents, whatever it is, to own this option strategy actually makes sense. And I think that's a distinct possibility. We could get above contract highs in the next week or below the lows, almost below the lows here of our range. But the problem is we only have 8 days to do so. So again, has to move here, now, and quickly for that to really work out. Now, the other idea is you make these into Mays. You give yourself a little more time, but look at how much more money you end up spending. This was more like 43, but the break even on this option strategy now, you need over the next, granted we have over 40, what did I say? We have, for May, 36 days left on it. We need to get above the break-even threshold now. You can see here where it crosses the zero threshold. We got to get below 671 or above 830. Very obtainable, but a long way off. And when we take a look at, below 670, we got to go below the lows of the month, and certainly well above highs of the month, contract highs, for that to be, a profitable strategy at the end of life. That doesn't mean you can't make money on it in the meantime, but generally speaking, anytime you stay in this, in the middle of that range, you're just decaying time value, and from both sides. So you end up bleeding out. So you have to know a straddle, good for if we think the market's going to move here now. That's why I proposed that 8-day straddle. Okay, what is it going to do over the next 8 days? We're right or wrong. I think it is, if we think that maybe a news event that WASD was coming up over that 8-day horizon would be enough to shock the market out of that threshold. Okay, now we're talking about the ability for the market to move that much, given that there's some news event or what have you, right? It's not just about a hope and a dream, right? There's an idea behind the volatility associated with news events that can help straddle actually, in the short term. All right, so let's take a look at soybeans now. Took a nice hard look there into the corn market. A good reason why this bull pennant we could be witnessing and waiting for it to break out to the upside. Exact same idea here on soybeans. Let's just go right into May of 2021. Go back, look at that same breakdown that we had. So here's May of 2021. Market didn't look that great. This is the end of the month. That's the last day of the month. So we're like right here. We'll bring it over here. We're somewhere right around here. Let's call it that right there, right? We just had this first up day after the low day. We thought it was going to break down. It's not. We're still caught in what? Arguably a range in this market, right? Man, I got to hurry up. We got to get to doing how to pick a range, and I want to look at the spreads. So much time, so little time to look at stuff. Here's your daily chart, right? Up till now, on the right there. Not the exact same, but very similar in the sense that we had some early volatility to start the month of February here or the year. That's set up with, kind of generally a range-bound market. Some, early year volatility set up a range for the year. That range started to break, whatever. We kept trending a little bit. We're not exploding, right? We didn't have a reason to explode yet, but we weren't falling apart. Well, that's how I would describe the current soybean situation. We're not exploding yet, but we don't have a reason to fall apart. Well, over the next couple of weeks, though, we certainly continued our range-bound price action last year. Soybeans took until mid-April to really bottom before exploding and rallying $2 in and of themselves at that late point in the year up into contract highs. So very similar sideways to put you to sleep. We're all wanting that explosive price action. It's possible, and if we see a repeat of last year, I think it could happen. It could happen. The possibility is there. I'm not saying it will. It's just the possibility is there. All right, 18-day moving average here for that May soybean. Again, very supportive, beautiful look to it here. staying above it and closing back above that 1660 area. Good look. Haven't been able to break above that 1640. Pretty big supportive line in the sand here. A little bit of head and shoulders. You got a left shoulder neckline here at 1640 head here. A right shoulder would form back up into a move of $17. But if we go through and above, it'll just, the head and shoulders pattern will just be a bear trap. But if we do break 1640, I do think there's not much in the way that'll keep us from testing $16 or even back down to 1550. 55-day moving average down around 1532, 100-day down around 1417, and 200-day down there whopping 1368. The launch pad for beans took us from 12 up to the levels we're at, so even a 50% pullback could take you to test these old highs around 1450. Oversold on the daily technical indicator, so again, another reason I think this bull, or this pennant or sideways structure will resolve higher. We're not really getting follow through on these oversold days, which suggests to me the market's oversold in a bull trend, which is a buying opportunity for the market to go higher. But the market doesn't care what we have to say. Although we did have a good gut feeling this morning about maybe seeing the bell trade higher, but it was a coin flip, right? At the end of the day. So let's take a look. Smaller time frame here for soybeans. We'll get into a strangle in this market. Maybe what does it look like selling premium well above this marketplace up at 1860, selling premium below down around 1560, right? Equal distance from where we are right now, and seeing a 1460 rather. Anyway, we'll take a look at what that looks like. And how to turn that into what we refer to as an iron condor. So if we like the idea that the market could stay in a range for a little bit and then break out of that range, there's something we can look at and neutralize some of that sideways price action. Get the market to pay us that period of the market too. 4-hour chart here, we've got some trend lines we're breaking through, against the highs. This has been a pretty choppy move to the downside. So at any point, because we've been in a very big uptrend and because we've had these kind of higher highs and more importantly, these higher lows forming, we can just assume that at any moment of time, this market could go higher if it wants to. All right, so from this 1580 area to $16, as long as we're above that, and really the 1640 has been my line in the sand. We've talked about it's the low of the month so far. It's proven itself time and time again, and now we've got trendline support against the lows here, coming in and kind of giving us some support at that level too. I do think we've hit that point of that apex, right? The point of boiling point. I keep saying apex, that's not the right word. We've hit a boiling point for this market that we're expecting it to break out here soon, or at least get a test back to $17. If it fails again and rolls over, okay, price discovery done. We don't want to go through above 17. But while we're in this range, and certainly setting up a head and shoulders pattern, right? Left shoulder, head, right shoulder would be up into 17 with the neckline down here at 1640. I'm not trading that. If we went below 1640, great reason I might become a seller and sell breakdown of a trend line here, because I do think this would, this is the type of setup that when it goes, it goes. Which is why I don't love the idea of selling a strangle this late in the game. The point to identify that strangle was right around here, was earlier, and we'll look at now, I think, our strangle. Yeah, we'll look at now how to identify sideways price action in the trend. You got to remove some of this stuff so that we can. I want to have enough time to go over this real quick, but there are some little tricks I have found over the years to help me go from following and tracking a trend to doing something else. So this whole trend higher, and you'll just have to take my word for it for the time being. But there was a means of tracking with fibs. Same anchor, new highs. The longs continue. They break out. There's a new period. There's a new pattern that can form. You start measuring from lows to highs, and you expect the market to hold a 50% level. And particularly when you find a level where the market got a reaction and then failed, you need to use that to your advantage somehow. Because we're only looking for footprints in the sand, and knowing that the market reacted from this level initially is important to me. So that swing from 1546 low to high, that 1759 high that then we fell off of, that 1652 area we got a reaction off of. In fact, we got enough of a reaction in this case. This is how I judge reaction. If I put a 38.2 line on this chart, it'll show up as blue. The market basically bounced from the 50 back to that. When I see that type of reaction off of the 50 back towards a negative 38.2, immediately I start thinking, okay, the market has the ability to go from this level now up to its negative 23.6 and continue that trend higher. When we did not do that, we broke below the negative 61.8 line, I immediately remove that fib and we start drawing up the counter side or the other pull. We're going to leave that fib up there for a moment because we're going to come back to it. But that counter side, then we expected the market to then rally back up into 1670 and hold. It didn't. It went right up and broke that 61.8 line and kind of went up and really punctured it and then started coming back down. Well, once we broke that 61.8 line here, right here, you see we went through all the way up to 65, started drawing up the fib from low to that high and looking for a 50% retracement to hold. Okay, that one holds to target. So a trend kind of began. Next one in that series fails. So that one failed out. So we see if now the entire swing from low to high, because now it doesn't go one step forward, two steps back, one step forward, two steps failed. And maybe this is then one step forward, two steps back, right? Well, so far it's holding, which is a good thing, which leads me to suggest that maybe the bulls are taking back over and I'm not too enthralled with a strangle at this point. But if we go back and we remember that this market broke the 50% short off the high and broke a 50% long off the low first, that moment that we had a break was the first moment that we started concerning ourselves with a range. And actually, it's typically at this moment where I'll put up and start drawing a box on my chart, signaling that I just identified a double failure, break. And if we edit studies here, and let's just add an awesome oscillator, give you a momentum indicator here, because I just want to show typically what ends up happening is double divergence, or someday. Didn't work too well on this chart, but the idea is that you start right. You get some extremes on that trend on the oscillator too, and then every new high after is like less. That's what we call divergence. Okay. Anyway, point wasn't a great example here from the momentum indicator, but you can see the peak and the valley that we're trying to reference, and you can get the idea that if we have a high and then break and then fail, you're going to get that divergence in what looks like a wedge forming in the awesome oscillator. It might show better for that oscillator on the hourly time frame than the 4 hour here. There we go. Yep, perfect. Shows way better on the hourly time frame than the 4 hour. That's fine. See the big two breaks correlate with the peak, the double break high and low, and then every high and low after that kind of peter down and diverge. Right, you go lower, lower. Generally speaking, there's of course a little bit of extra push and pull, but then once they start to get a little bigger, that's when the market is building up that momentum to maybe break out. And that's what we feel here, is that I feel that this was a fake momentum break to the downside, and now we're starting snapping back the other way. Anyway, this double break set up initially right here last Wednesday us into sideways market thinking. Okay, that's why these ideas became enter into the mindset, and we start discussing what do we do in a sideways market. You're paralyzed by volatility. Well, then you have some time to think about it. And then if you had put one of these strategies to sell premium on, 2-3 weeks ago, right, you could be just eating up that time value throughout that period. Because a strangle here is designed to make money if it stays between, in a range. And so now that we've identified, okay, maybe a market's in a range technically, even though we're seeing some good technical signals for how we could break out to the upside, we're starting to draw, those trend lines to discern a wedge-like pattern, right? And on all the technicals that you follow through with over the last couple weeks, generally speaking, all support the idea that we're going sideways in a range, at least in my opinion, until we're not. And there's a head and shoulders pattern that suggests we could break lower here, as well as 50% retracement, some little momentum building that suggests we could break out higher. There's trend lines that break to confirm either direction, so we'll just continue to pay attention to those. But in the meantime, if we think we're going to stay sideways in this range, or we want to turn it into an iron condor, I was looking at a 1860, 1560 call spread, or excuse me, what do you call it? Straddle here. Strangle, excuse me. We need to go to analyze. We're going to flip over to the beans. Yeah, these are off a little bit, and I'm realizing why, because I didn't pick perfectly displaced, right? 1860 is a little further than 1560. So here I want to go down to 1460. Well, it's going to be a little skewed to the call side here. All right, so it looks like 1460 calls or puts are going to bring in, let's just call it 13 and some odd cents. It's not as much as I'd want. I want to get a little bit more than that. We're going to go with the $15 strike here. And it is going to be slightly skewed, but that's okay. We can account for that later. When I say skewed, I mean not equidistant from where we are in the market to the two things. But ideally, you set them up so they are. So for the $15 puts, it looks like we would be able to bring in around, we're going to call it around 22 cents for them. The 1860 calls, those are bringing in go 26 cents on those. And let's take a look at the risk profile here. Okay. It looks a little different, an upside down V with this plateau. And that plateau represents the most amount of money you can actually make here. So by selling that 1860 call and that $15 put here, you have unlimited max risk. You can see how once you break below effectively go above $19 or below $14.50, the market has unlimited risk in either direction for you. We can take that into account by buying some options on either side that can offset that, which we'll look at here in a minute. But you're going to notice how we really need to really bust out for you to make any money. But maybe that's why you actually buy those in this environment. But for doing nothing, so long as the market over the next 90 days stays between $15 and below 19, you stand to make about $2,400 for the, what is this, 48 cents of premium you bring in. And that's, I don't want to say free money because there's risk involved, but being able to wait out with time value as a market chops sideways is a good thing. Now, I mentioned how do you, cap the risk on something like this, because obviously the market has a lot of time left between then and now. I would actually come in and utilize the June options. Remember, June trades off of the July contract, so you're trading the same underlying futures. We can cut down on our risk, but you have to realize there's going to be some margin and some delta difference here. We can cut down on the risk of or the cost of owning those protective options. And basically, this says that if the market moves very quickly in those directions, I want that protection immediately. But anything further than 64 days out, I'm going to leave unprotected for the time being. But for the next 64 days with June, you can be protected. So the way I would do this is we know that our risk is above 1900 and below, what did I say there, 1450. Let's just use those strikes in our options here. So we're going to buy a 1450 put. Costs nothing. Costs just going to go with an 8-cent cost. That's where it trade last. That's more than what we know it's going to cost, okay? And we're also going to add in here a $1,900 call. Costs a little bit more. Going to cost us 11 and call it just 12 cents. So for the cost of one of these options, we're basically putting on things that'll start to be profitable outside of that range. So let's take a look at our risk profile now. Looks a little different. Now we have built into the market a band where we can make money while we stay between, right? You see the green profitable line up here. We stand to make the most amount of money, which is about just under $1,000 if the market stays right here. The closer it gets to 1530, we can actually lose something. The worst we could do is if the market goes right to 1900, we lose all $3,000 of premium we put in. The worst we can do to the downside is we stay right at 1450, you lose 2,000. But if you notice here, it doesn't, because it caps out, we don't go beyond that threshold. But there is a threshold here where you can, if we start to alleviate one side or the other, because of your delta risk, after those 64 days, if it does become a futures position, you actually now have a gamma and a delta trade, or not gamma positive, you're delta positive on your futures, and these actually start to hook up and come up after that 64-day period. That's, if it's funny, it's like after 64 days, if you were wrong or we go outside of that range and you don't make the premium you're hoping to stay if we just stay put, because the whole trading strategy here is that still for the 90 days, we just stay put and inside of this 1550 to 1770 range, and you'll just bring in premium. But if at some point we start to break out of that range and you do get assigned a futures position and the market's moving, your risk is still capped because of the futures and everything you got on. However, if we start to move beyond one of these thresholds, these lines that you've drawn here, it didn't work out how I was hoping to show you here because I'd have to flip a switch and move this over to futures. But you actually end up, continuing on and can make money because you've got a future which is worth 1 and the options delta is worth 0.5. So your future is now gaining for you in that direction. You can actually make money the further we move away outside of, in this case, it would be below. We really have to go below $13 or above $20, but you'd start to make money again. But hey, it's a little more complex. Lots of legs, lots of things going on. But it's funny. It's interesting how you can, curb and create with options exactly kind of what you want to see in terms of trade. All right, we have pushed into way beyond our time, but that's fine. We've talked about how to create a Strangle, turn it into an Iron Condor, and limit the risk by buying options on either side. But not exactly trades I'd put on right now. Nevertheless, we'll see. Real quick, man, we're not even going to get into wheat today, but let's take a quick look. There we go. Wheat having pulled back to a full 50% retracement from its swing lows here from the 728 area all the way up to 1330s. The market began this Ukrainian crisis rally around the $9 threshold. We broke through $10 and ran up there. So this pullback we've seen over the last couple days really back to test broken resistance now is support in my opinion. We did break below trendline support here, so this could be the market gearing up for a leg lower. It was a 50% short from its latest 11.59 highs to its 10.31 lows. Don't love seeing that. But if we do break back above $11, get back up to 10.60, I do think, we got to consider this is that bigger 10.50 area holding. And why not? Why can't wheat just trade up into $12 to test that full 50% short off the highs? That's all I got to say about wheat. You're a psychopath if you're trading it, and good luck to you. I really want to touch on the corn and the bean spread today before we sign off and do about anything else. Corn spread here. This is your July, November. Okay, old crop, new crop for this year. Corn spread. It can go up to $1.50 to $2 wide. Don't you deny it. Trendline support here against the lows came in here at 60 cents over. It's holding. It seems like we're trying to break, break in trendline resistance and now making higher highs and higher lows. A little bit of a key reversal here today, or not key reversal today, but an outside day reversal to the upside. And I would expect this to get back up towards that 80 to 90 area to test the dollar market's resistance. Take a step back on that daily time frame. You can see how we broke through trend lines already. This is a market that looks like it's starting to stair step higher. And if you're not drawing this channel on this chart right now and thinking, oh boy, we are bull spreading here in old crop, new crop, and channel resistance isn't until $1.20 over, and that is 50 cents higher on this spread. If you're not thinking that we can't break out in old crop corn right now, until we get below 60 cents under, there's really bullish case, right, that I can make for it. So let's continue to monitor that, and that's a big reason I think canary in the coal mine here. Today's green day I think is the first. The fuse could be lit. If that dynamite catches, we could have a pop here, and we're due for it. We've had some really quiet markets. That doesn't make sense to be as quiet as we are, right? Same channel here. We talked about in the past, but give it give it its own credit is due where we see it here. Channel support's traded around $1.65 over. Channel resistance could take us up to 220 over.
You're kind of in the camp of things will be better.
Not much else to say. Just a pretty nicely bullish looking daily chart here for that July no bull spread. Yeah, I'm not a big technical analyst on these things, because there's spreads, they trade a little differently. Trend lines work well, some fibs work well, moving averages and other things tend to not. But I do like what we're seeing, and that the higher highs and higher lows progressive nature of this chart suggests that any kind of supportive price action we're seeing in the underlying futures being confirmed is some bull spreading in the spreads. So looks good to me in terms of maybe a low end of the range at least being put in at this point, and the market's wanting to take off higher. So that leads me to believe that I think maybe some call spreads in wheat might make sense here. Let's take a look there real quick. Corn and beans, honestly, I'm looking to kind of buy the dip now against the lows. 640 stops on the soybeans, 730 stops on the corn if you want to go in the futures. $17 calls, sell some calls $1.20, $1 to $2 above on the beans if you wanted to turn it a call spread. May corn, maybe just own $8 calls outright at this point. I don't hate that idea. What are they going for here? It's a little expensive at 21 cents, but heck, cut that cost down. Sell $8.75, bring in 8 cents. So anyway, there's plenty of ways to get some upside exposure now. I think we're at the start. The train hasn't left the station, but this is definitely a time where if you're not already long or looking for markets to kind of come back for you, certainly many of my clients are. We're still in those 1640, 1660 calls from before that we sold $18 calls against. We bought those back in this volatility, and we're letting those long calls ride now. That's the idea, and most of the positions we see over the last few days, that's what we're doing, right? Because we use this to improve the strikes that we could maybe make money on later down the road. But I did want to at least leave this, because if we're looking, that's probably the one place where trades, many of us don't have a trade on already. But yesterday I was looking at, wrote this down somewhere. Did I throw it out? I did. Doesn't matter. In the wheat here, we were looking at $12, $13 call spreads, I believe. That dollar, and you could turn it into $13.60. Yeah, bringing in 22 cents for the $13.60 call. $12 call was costing you 48 cents. So you're cutting down that $1.60 wide call spread right now in the wheat that you have 36 days left on. So there's no reason we couldn't go back up to contract highs, which is, by the way, the level we sold here. I think we could go through it, honestly, if we really wanted to and we get crazy, but let's not get greedy, because you only have 26 cents out of pocket risk here for a $1.60 wide spread that has 36 days on it. Again, I don't love some of the technicals we saw in that wheat chart we looked at earlier in terms of what, fearful of the market rolling back over, but At the same time, sometimes you got to risk it to make the biscuit, and this is one of those instances where at least you can have finite risk, bringing in 22 and 7/8 cents, selling the 13.60 call against owning a $12 call here at 48 cents. You stand to make that $1.60 if we get back up in the range to the high end of the range and threaten contract highs. So, that pretty much wraps up today. I wanted to go over what a straddle strangle kind of were. There's not much to do in this environment right now other than maintain the positions you're in. There's trend lines that I would be a buyer on the breakout of. Start going above 16.80, look for $17 on soybeans again, and above 17.20 then. We negate the idea of that head and shoulders pattern, and the market's probably breaking out. I am fearful that going into this WASDE report, planning intentions and acreage reports and quarterly grain stocks could see a little more volatility. So any bout of volatility like we saw last April in the soybeans, we use it as a buying opportunity or reason to buy back short calls to leave that upside exposure in hopes of that $2 move higher. Similarly with corn, didn't get as much of that bout of volatility. I think there's some lines in the sand we can start positioning against here. And certainly if you're willing to accept risk below $7 or a $7 stop effectively on corn, you can be positioning here for that breakout higher, but that's a long ways away. So with all that being said, have a great day, everybody. Thank you for joining me here today. For those that have stuck around, wanted to also call your attention. There's going to be some links in the comment section below and everything for wanted to let everybody aware, and particularly our producers out there aware, that we have a brand new app we just launched, the Zaner My Farm app. You can think of it as kind of QuickBooks for the farm. The idea being is we have identified there aren't enough tools to bring all of your financial risk management solutions together into one, whether that is your looking at your sales receipts, bringing in all your cost analysis to one platform, breaking it down by field, and even scale ticket. We can take a look at together how your farm is doing from a balance sheet approach, right? It helps us, the broker, put together a risk management solution for you that makes sense in terms of where your risk management or risk exposure is. And we often don't know that without really taking that deep dive into what the cash sales have been, what forward contracting we've put on and worked through together, or you've done on your own, and putting that all together in one place so that we can build a futures plan that works together and around that. And of course, you get to see it all in one place, right? So cool tool we put some time and effort into, totally free, all completely developed in-house and kept in-house, so there's no worries about where your data and information is going, but a new tool that we're pleased to be rolling out here for our farmers and producers that need any kind of help with that financial balance sheet. So, all right, everyone, thanks for joining me again. It's going to be a rocking and rolling end of month here. I think it is the starter pistol for the new season, and for all intents and purposes, I don't think there's any reason to be really bearish these markets just yet. We'll see if the rains continue throughout the Midwest. Getting into a good production year is going to be one thing. Those acres are definitely going to be there. I don't think we're going to have a small acreage number or planting intentions by any means, but it's going to be interesting as to where those acres get committed, because almost every crop you can put into the soil and grow right now is in competition in terms of price for those this year. So have a great day, everybody. We'll be back with you as price action develops. You can always reach us over here at Zaner in case you didn't already have my contact information, 312-277-0110. Find me on Twitter. Shoot me an email at dhussey@zaner.com. Or find us over here at DanSOTD on Facebook. Have a good one, everybody, and we'll talk to you later.
Trying to give out my number there.